So, when a company decides to sell off a piece of itself, a process we call a carve out, you might think separating the finances would be pretty straightforward. But you know what? It's often more like, well, financial archaeology. You literally have to dig through years of combined records to piece together a financial story that can actually stand on its own. So, let's grab our tools and see what this excavation is all about.
First, we're going to map out the dig site by looking at the financial separation puzzle. Then we'll assemble our A team of experts, because you can't do this alone. After that, it's time to excavate the data, and then the really fun part, rebuilding the financials from the ground up. And finally, we'll look at a few situations where you can actually skip the full-scale dig.
All right, first things first. We really need to wrap our heads around the fundamental challenge here. What exactly are we trying to pull apart, and what makes it so darn complicated in the first place?
And this is the core question, isn't it? I mean, imagine trying to separate the eggs and the flour from a cake that's already been baked. It's kind of like that. The finances of a business unit are so often just completely mixed into the parent company's books, sharing everything from bank accounts to IT systems.
The whole goal of this entire process is to create these carve-out financial statements. And the key phrase here, the one to really focus on, is as if it had been operating independently. You're essentially creating a believable historical record for something that never, ever stood on its own 2 feet before.
Now, you gotta know, not all carve-outs are created equal. There's what we'll call the easy way. If the business is already its own separate legal company, well, separating the books is way, way simpler. But the reality? What's far more common is the hard way, where you're carving out a product line or a business unit whose operations are scattered all over the parent company's structure, usually for tax reasons. And that is where the real digging begins.
And look, this isn't just some creative accounting exercise. The guiding principle for this dig comes straight from the SEC. The financials you build can't just be a fantasy. They have to include all the historical activities that are a real part of that business and are expected to continue. You're building a faithful reconstruction, not some work of fiction.
Okay, so this is obviously not a one-person job. A successful financial excavation requires a very specialized, cross-functional team. You absolutely cannot do this alone.
Your accounting team is going to lead the charge, of course, but they can't do it in a vacuum. You desperately need your IT folks to actually get the data out of systems that were never designed to be pulled apart like this. You need the business and operations people who know where the bodies are buried, the real costs in R&D or sales commissions. And this is crucial. You bring in your external auditor from day one. Do not wait. This way you don't spend months building something that just gets rejected later.
With the team in place, it's time to start digging. This is the hunt for the raw data, for those financial artifacts that are scattered all across the corporate landscape.
What's really interesting is this huge gap between perception and reality. Management often looks at a high-level report and thinks, hey, we already track revenue for this product. This is going to be a piece of cake. But they totally forget that balance sheet items, like who owns a specific factory or who's on the hook for a liability, are almost never, ever tracked that way. So, once you start finding this data, you need somewhere to put it all. You've got two main options. You can create a dummy company right inside your existing ERP system, which is great because your staff already knows how to use it. Or you can use an external tool. This is often faster to set up, and it centralizes all the carve-out adjustments in one clean place, which can make life a whole lot easier for the auditors and your tax team.
Okay, we've got our team, and we've excavated the data. Now comes the most critical phase of all, actually assembling the skeleton and creating that complete financial picture from all these scattered bones. A good project plan is everything here. You treat each line of the financial statements, like revenue, cost of goods sold, whatever, as its own mini project. But the really crucial step, the one that causes all the arguments, is step 4, agreeing on how to split up shared costs. I mean, how do you divide the CEO's salary or the cost of the corporate IT department? You have to agree on logical drivers, like headcount or revenue, and you have to get the auditor to sign off on them early. And now we get to what is almost always the hardest part of this whole thing, the balance sheet. Like we said, companies just do not track assets and liabilities by business unit. There's no magic button you can push to get a clean report. You have to literally build it from scratch, piece by piece, using information that was never meant to be separated. This takes a ton of judgment and really deep analysis. And this slide just perfectly illustrates the headaches. I mean, think about it. If the parent company and the carve-out share customers, how do you split up the money they owe you? Who gets the factory they both use? How much of the parent company's old debt should be assigned to this new little company? Every single one of these questions requires deep analysis and really well-documented assumptions.
Okay, so once the balance sheet is underway, we can turn to the income statement. Now, a lot of people think this is the easy part, since things like revenue and direct costs are usually tracked more closely. But a huge puzzle still remains. What do you do with all the corporate overhead? All those indirect expenses that benefit the whole company now have to be logically divided up. Right, so the SEC says you have to make a reasonable effort to allocate these indirect costs. You can't just pretend they don't exist. You also have to calculate income tax as if the company were a standalone taxpayer, which is a massive project all by itself. And you have to figure out which costs of the deal itself actually belong to the carve-out. It's a lot. So after all that, you might be wondering, do you always have to go through this incredibly intense process? And the answer, thankfully, is no. There are a couple of alternative paths you can sometimes take.
The SEC might, if you're lucky, grant you a waiver for what's called abbreviated financials, if the business was never really a separate division and its costs are super integrated. It's a much simpler report. The other main scenario is when the buyer is small and doesn't have to report the acquisition to the SEC. In that case, the seller has a lot more flexibility, but they still need to prepare clear financials for the buyer to check out.
Okay, let's look at a real-world example of this in action, because this stuff happens at a massive scale. A huge Fortune 500 healthcare company decided to spin off a business that made up a whopping 40% of its entire revenue. And this business had operations in over 60 countries.
So how in the world did they pull off such a monumental task? What was the key? It was all about upfront planning. They were smart. They realized that 90% of the business's income came from just 10 countries. So, by focusing almost all their effort there and using simpler methods for the rest, they managed to hit an incredibly aggressive one-year deadline.
And that really gets to the heart of it, doesn't it? Creating carve-out financials is exactly like carefully tearing a chapter out of a novel and then giving it a new beginning and a new end so that it can be read as its own complete story. It's a process that takes technical skill, deep business knowledge, and just a whole lot of careful planning.